What's going on, guys? How are you? This is Shocks and this is Shocks Capital FX YouTube channel. Today we want to talk about supply and demand, guys. I have seen a lot of you guys talking about supply and demand, trading supply and demand, but you have been doing it a little bit wrong. So what we're going to be doing now is we're going to set the framework to understand how to actually trade supply and demand the right way, how to approach the market, how to take your trades, how to do everything, how to choose the best supply and demand zone. So watch to the end so that you guys can clearly see what you are talking about when we talk about supply and demand. So to generalize matters, supply and demand is actually shown in the market after the move, right? So what we are waiting for is we're waiting for aggressive moves like these ones, as you can see from this chart. From these types of moves are the moves that we are waiting for, these aggressive moves that stick out on a chart, right? So you understand what I mean by sticking out on a chart. We say there is this move, there is this move, and there are all these moves that stick out on this one, on this chart. So these are the moves that you are going to be studying, and those are the moves that are going to tell us the story that we need to hear in terms of supply and demand. So supply and demand, we're going to be looking at three different supply and demand criteria that we can use. So number one, we're going to be looking at one candle demand supply, and we're going to be looking at zones, and we're going to be looking at what we call a weak supply. Not weak as in WEAK, not that weak. We are going to be looking at the rejection supply criterion. So what we are going to start with is the simple one, the candle supply. So what we are going to be looking for is a move. We're going to be looking for a move that sticks out on a chart. So from what you are seeing here, I'm going to choose this move right here that you see on this one, on this AU chart, this move. So this is our move. And where is your supply zones? Your supply zones are going to be where the move originates from. So this is going to be what? Your supply. And you're going to be choosing one candle, and that candle are going to be naming it a decision candle. So the decision candle is going to be this green candle that you see in this area before the black move. So we are going to be looking for what? For the green candle. So it depends with how you have structured or how you have set up your chart. If you are having black and green candles like me, you are going to be using the same colors, then you can relate easily with the colors that I have here. And when I say we're going to be choosing the green candle because you have had a black move, this is what I mean, right? So this is how you are going to be looking at what? At supply. And you are going to be avoiding moves like these where you are not having an aggressive impact into the what? In the market. So what you are going to do is you are going to be looking at these aggressive moves, and you are going to be marking out what? We are going to be marking out these candles where price is going to what? To retest and go. So what we are going to do is we are not going to be trading supply and demand right away. So by that I mean, when we identify our supply or when we identify our demand like this, let's say this is a candle demand, as I said, one candle demand, right? So what we are going to be doing is we are going to be waiting for price to move back to what? To this zone, so that price goes away like this. So this is what price has to do, or this is how price moves back to the demand zone. So this is your demand zone, and this is how price should move back to the demand zone in consolidation form, and this is how price should move away if you are correct, or if you identified the correct demand zone at any given time. So remember, when you are looking at this, this is what you are looking for. And if you are looking for at this chart, you will clearly see that we have an aggressive move up like that. And what do we have? You have a demand zone like that. And if you have to choose a candle, you are going to choose a candle like this, where you are going to be marking the high of the candle like this. We mark the high, right? Then you are going to be marking the what? The low of that candlestick, and this is going to be what? Your demand zone. And you are going to go up in time and understanding how it's going. So if you're looking at this, you see that price spiked through the demand zone and you have lost the trade, right? Exactly. There's no strategy that is 100%. I always tell you that. So if you are going to be using demand and supply like this, you are going to need to put your stop loss, right? So your stop loss is going to go below the zone, right? Below the demand zone. And if you are going to be using a candle, you are going to put your stop loss below a candle if you are buying, and you are going to put your stop loss above a candle if you are selling. Okay, let me give you another example where you are going to see your stop loss being taken, and this is what I'm going to do if you don't subscribe to this channel. So guys, subscribe to the channel so that you don't get your stop loss taken. Right, if you want know how we do it, right? So I'm going to give you another example that is a real-time example, right? So if you look at this, this is AU, and this is your demand zone. Why? Because you have been having a momentum push to the upside and taking out all this. So what you are going to be doing here is we're going to be marking out the high of this candlestick, and you're going to be marking out the low of this candlestick, so that we can clearly identify or determine our stop loss, as is seen with this one, with this profit and loss too that you can see here. So this is how you would map up your trade if you're going to be trading with the candle demand or supply. So let's go to another thing, and let's go to another chart and try to understand what we mean by what? By zone, demand or supply. So what we mean by this is we are looking at consolidations, right? We're looking at consolidations. For example, we're looking at this consolidation as our demand. Then we narrow it down to what? To a specific a candlestick that we say is is a decision candle. So in this case, we have this decision candle and we have this zone. So in this case, we are marking a zone as our demand area. So this is our demand zone. Why? Because we have had consolidation, then we have had price breaking out of that consolidation in a momentum shift move, or in an aggressive manner. So this is what we are doing, and this is what we want to see as price is moving away from from consolidation. And if you look closely here, we have a consolidation right there. We have this consolidation, and we have a breakout out of that consolidation. So this would be your trade if price comes back to this zone. So you see price is trading back to that zone, and the stop loss is going to go above that zone, or you are going to be refining that zone so that you can reduce your stop loss or your exposure in terms of the risk that you are going to stake on that trade. So with that being said, we will go and look at the last and most effective way of demand. So with that, we are going to be looking at the wicks in the candlesticks, and we are going to be marking we're going to be marking the wicks and identifying our demand and supply using the wicks that we are going to mark out. So if you are looking at this, what do you see? If you are looking at this chart, you can clearly see that we have with wicks in this area. So what we are going to do is we are marking wicks and expecting price to trade back into those prior wicks that you see here. So this is what we call rejection, demand and supply. So you see wicks here, and price trades away from the wicks and trades back into the wicks, as you see in this example. So when you are trading supply and demand, what you want to see when you are trading wicks is you want to identify the wicks first. If you have identified the wicks, you wait for price to come back and trade into those wicks, and your trade is going to be that as price is trading into your wicks, right? So if you look at this again, you will see that we have wicks there, and price is trading back into the wick. So when I say wick or rejection, demand and supply, this is what I mean, and this is how you should approach it. So last but not least, we're going to be looking at the entry techniques that you can use as you are using supply and demand. Perhaps you don't want to be trading straight away from the H1 and trading and using limits. What you are going to be doing is you are going to be identifying your demand, but as soon as price hits or price gets into your demand zone, you are going to the lower time frame, perhaps the 15 minutes time frame or the 5-minute time frame, and you are going to be analyzing and expecting to get your trade from the lower time frames. So when you go to the lower time frame, look at this. When you go to the lower time frames, you are going to be waiting for what? You're going to be waiting for your patterns, right? You're going to be waiting for your patterns in the what? In the lower time frame. So let's just go and scroll and look at the trades that we had marked and see how would you have approached those ones, right? This is a price getting into your what? Into your demand zone. So what you can clearly see right now, you want to see a stop hand into the demand area, and the stop hand is this one. So you see price making a high, right, and striking above that high as is in the demand zone, and you see price moving away. This is what we call a choke change of character. So you need to see a change of character as price is trading away from the demand zone, and you need to see a move back or a retest of a what? Of a fair value gap that price is going to what? To see. So after this, so as price trades back into this fair value gap, this is your entry, and your stop loss is going to go above the what? Above the area like this, and you're going to get your what? Your entry into in the fair value gap like this. So this is going to be your entry, your stop, and you are going to drag this all the way to your what? To your next low, so that you can maximize on this. So remember, we're on the lower time frame, and this would be a very good trade. So this is how you would trade supply and demand on the lower time frame. You will be waiting for number one, a stop hand. Number two, you'll be waiting for a break of structure or a change of character, then a move back into the fair value gap or an order blow, depending on what entry technique you want to be using in your trading. So this is it, guys. I hope you benefited something from this. And guys, if you are looking for a very good trade, a very good broker that you can trust with your limits, that you can trust with tight spreads, I have Mugen Markets in the description down below. Register down below with Mugen Markets, and be sure to be trading with the leaders of this industry and getting your withdrawals in time. Guys, I'm Reshmakers. This is Shocks, and this is Shocks Capital FX. Trade what you see. See you on the other side.